Yeah, it's not looking that great. I mean, frankly, if you ask me in terms of shakeout, no, shakeout is not the right word, but there is definitely a ripple, so to speak. Let's look at all the contours here. The dollar index is at a 6-month high. That's the first indicator of which way the risk is moving. Bitcoin has slipped. Euro is at a 3-month high, and the bond yields are inching higher. Why do bond yields inch higher? Very simple. If the markets are expecting inflation to stay stubborn, or they expect Fed to increase rates. Now, Fed has already opened doors by indicating that a rate hike cannot be ruled out, and looking at the scenario, they cannot commit to a pause, and they've kept that statement open. So that has coincided with the surge and comeback in commodity prices, strengthened the dollar index, and that has led to an appreciation in the bond yields. And there is a little bit of risk off which has happened in Bitcoin. So I'm saying that you got to just be watchful now in terms of the data points. And there's no alarm bell. But in terms of the tone and the tonality, there seems to be a subtle indication coming from the currency market and from the bond market that you just cannot assume that rates will go lower, and you cannot assume that Fed will not move again in the second half of this year.
And should the Indian market investors then derive that, you've got to even up your warning signals antenna further?
Aisha, look, you look at the market from the eye of Nifty. Frankly, you've done nothing. And let's look at the YTD graph for the Nifty. Now, with all the hullabaloo in the market, where the market cap is, let's first look at the Bank Nifty and the Nifty YTD. That, in a sense, will really establish that where the market has moved. The Nifty in this year has appreciated by 9%, or I can just say just 9%. Bank Nifty, despite the leadership sector, has given you a return of 3%. But the minute you turn your attention to the small and the mid cap index, it's a completely different kettle of fish. The small cap index is up 27%. The mid cap index, is up 27%. And for the small cap index, the gain is 30%. And I'm not even getting into individual stocks, and I'm not even talking about what is happening in the SME space. Historically and traditionally, when you have seen these levels, the market, at least in the mid and the small cap stocks, either tends to correct or it tends to consolidate. I think we are reaching there where the markets are due either for a sharpish adjustment or some degree of consolidation. We are not at a bubble level. We are not at a euphoric level. This is not 2014 yet. This is not 2008 yet. But in terms of a risk-reward ratio, now is not the market where you just want to be blinded with momentum. You want to be careful. You want to be in capital protection. And if you cannot take a 25 to 30% downside, I guess this market, mid and the small cap space, may just not be the right space to be in right now.
Yeah, perhaps run its course already. And just yesterday, it was interesting that we were talking about previous instances in which we have seen the broader markets take leadership. But just to paint the picture, yesterday, the cues from D Street is that you had the frontline indices. It was a choppy day of trade. We ended around the 19,570 mark. 3 straight days on the trot, at least, that we've been seeing that gaining momentum and leadership being witnessed within some of the large caps. So they look like they're coming back to the forefront, the likes of RIL, for instance, ITC, or even Infosys. While FIIs remain sellers, DII is the buying figure. That continues. 13 straight sessions on the trot. And yes, the broader markets, you saw the year-to-date chart, bulk of it has happened in the last 1 month itself, and quoting at life highs. So Nikunj, DIIs remaining net buyers, and the fact as well that you've also got leadership from some of those large caps and just tracking the technical RSI levels as well. What is that indicating?
No, look, not everything in the market is overbought. Not everything in the market right now is underappreciated. Now that is how things are looking up in terms of the RSI level. Mid cap, small cap, and the real estate index are overbought right now. And when indices have reached what are called as these overbought levels, the future return in the short term, it tends to get compromised. And this is something we really need to be cognizant of. In terms of where the market is moving, Nifty, the BSE, and the auto index, these indices are very overbought right now. So my point is that if one really goes by the technical indicators right now, very few pockets are there which are in the buy zone. That includes energy, pharma and infra. And that is where if see in a bull market, what will happen is that the overbought sectors, they will get into consolidation or they will get into sideways movement. But if the market, and since this is a bull market, I expect the underperforming sector now to start rallying. So in the second half, I will not be surprised as the market moves into some, as the froth settles down, the market action may really move away from IT and away from, some of the real estate stocks. It really could be back to banks and selective FMCG.
Well, talking about the texture of names that have been holding up off late, look at the list of stocks which actually held out by more than 15% yesterday, and just, stacking it up with the profitability that they have: MMTC, Dish TV, State Trading Corporation.
So Aisha, look, you have to look at price action, and the price action has to be again substantiated with what is happening in terms of the profitability of the company. And some names here are Dish TV, MMTC. These stocks are up 20, 15, 18, 20% from the recent lows. And look at the profitability what they have, whether it's 3i Infotech or MMTC or Dish TV. For FY23, they've reported fat losses. My limited point here is that if you're really buying some of the companies which have very little operating profit, or in the near term do not have potential really to report a strong profit, and the stocks are appreciating, then that is pure momentum. And this is my limited point here, that why do you want to avoid, you really want to avoid the temptation of buying strong momentum. Don't get trapped into the price action, because when markets will adjust, some of the stocks which have appreciated, where the fundamentals are slightly shaky, the end game really could be slightly poor.
Oh yes, indeed. Clearly